Hi, welcome again to Longevity in the Merciless Market. We're going to talk about trading strategies across different instruments. The first to join us is Alex Kozulin, who is the creator of DTP trading program, Day Trader Pro. He's been a professional trader for quite a few years now, and he'll tell us more about himself and tell us about what the DNA of a successful trader is. So, Alex, please take it away. Thank you for joining us.
Thank you, V, and welcome everyone to today's conference. As V mentioned, a lot of interesting speakers throughout the day. Now, as you can see, my topic is DNA of a successful trader, and we'll be discussing what I consider three main parts that need to be addressed in becoming a successful trader. Now, before we get into it, just some admin stuff to go through as well. So just please note that anything that we do cover in this session does not constitute a recommendation, and that views and opinions expressed are purely for educational purposes only. And Track Record accepts no responsibility for any use that may be made of these materials and for any consequences of that result. All right, so a little bit about myself before we get going. So my history is that I spent 25 years working in the corporate sector throughout various parts of the world. And in 2010, I retired from the corporate sector and moved back to Australia, primarily due to my children beginning their secondary or high school education, and we wanted them to complete that here in Australia. And that's when I began in 2010 my journey in the trading industry. So prior to that, I had no trading experience whatsoever. And so that's where I began. And part of that process, I participated or joined a boot camp that Track Record held in 2016 over a 2 day event here in the Gold Coast here in Australia. And pretty much now I am a full-time trader. Now, as the title says, creator of the Day Trader Pro. What is that? Well, historically, I would have classified myself initially as a swing trader. Over the course of my initial years, I started trading multiple strategies on different time frames. So a specific strategy on a specific time frame, and obviously culminated in multiple strategies trading multiple time frames. But at the end of the day, it got to a stage where I was spending hours and hours in front of the screen all times of the day, and it's really starting to take over my life as much as I love trading. So I wanted to come up with a different approach that's going to suit my lifestyle, that's still going to allow me to trade every day, but for a limited time. And so ultimately, the strategy that I created, I call it Day Trader Pro. So it's basically one strategy. I'm looking at one, maximum two trading instruments, and I'm focusing on one time frame, which is the 5 minute time frame. So I don't have whole positions overnight, so it eliminates a lot of the stress. And I, in fact, limit myself with this approach and strategy to a limited time. So I allocate 90 minutes per day for my trading, and I trade the same time every single day, which is the first 90 minutes of the London session open. So that's what I have evolved to. And I think as traders over the course of time, we do evolve to make sure that we can fit and maintain it within our lifestyle. All right. So the content today, as I said, it's titled DNA of a Successful Trader. So first and foremost, we're going to look at the different types of traders. So in life outside of trading, we all have different careers, different professions, and those careers or professions that we've chosen relate to our strengths and weaknesses. They depend on our personality traits. And so, you know, just because you're a good, let's say, electrician or a plumber doesn't mean you're going to be suited to be a lawyer or an accountant. So we choose our profession, career to align with our strengths and weaknesses, our personality traits, in order to ensure that we can succeed in our chosen path. And trading is no different. So the first part of what I like to say, DNA of a successful trader, is determining what type of trader or trading style best suits your personality traits, best suits your strengths and weaknesses. So we'll go through that. We'll also, once we determine and go through that category, I'll give you a little guide that may help determine what trading style may best suit you, because that is important to match the trading style to your personality. And then, irrespective of your trading style, your trading strategy, there are essential components that which must be addressed in your respective trading system or trading strategy. So we'll go through those essential components just to make sure you are addressing those within your own personal strategy. And then the other side of the coin is what I like to call the deadly sins of trading. These are all things that we do from time to time. Some of us more often than not, that we absolutely need to avoid. And in some respect, avoiding deadly sins is going to be of more benefit than actually the essential components. So they are the three parts that I consider that need to be addressed within the title of DNA of a successful trader. From there, we're going to talk about how to take advantage of current US monetary policy. And that's really to talk about that we know that in September of last year, the US Fed started to cut interest rates. So we're going to talk about that and look at how we can take advantage of that. We'll look at the gold and silver. Will the bull run continue in 2026? And in all fairness, I did have to update this presentation a little bit this morning because there was a major correction in precious metals last night. And so we'll be discussing that. And then I'll actually share with you a strategy which takes less than 5 minutes a day for those who are busy that you can add on to your normal trading strategies on how to trade precious metals and the US stock indices based on those two previous points. All right, so a lot to get through. So let's begin by quickly going through the types of traders. So if you are new to trading, these are the broad categories of traders. There are scalpers, there are day traders, there are swing traders, position traders, which in essence is long-term trading, algorithmic traders, and carry traders. So again, there are broad categories, and you can actually have a hybrid within each of those categories. So to quickly go through those, if you're not familiar with what each of those categories or types of traders are. So a scalper, you're literally in trades from seconds to minutes, and generally the trade frequency is very high. And your objective there is to capture very small price movements in the market, something like a 2 to 5 pip movement, and then you're in and out of those trades. So what's important here, you obviously need to be fast in your decision making, and you certainly need to be disciplined and excellent in your technical analysis skills. And here, as a scalper, you're really looking at 1 minute charts, so very fast moving indeed. As a day trader, what that generally means is that if you're placing a trade during a particular trading session, whether it's the Asian session, the London session, or the US session, you really want to be out of that trade before the close of that session. And generally, your trade frequency is moderate to high, and you're looking to profit from those intraday price movements. And like with scalping, you certainly need strong technical skills, and you need to be able to read the sentiment of the market. And typically, you're trading anywhere from a 5 minute chart to a 1 hour chart. And so with me as a day trader pro, I'm looking at 5 minute charts. All right, swing trader, this is what I was mainly previously. You're in trades from several days to potentially 2 weeks. Obviously, higher time frames, so therefore your trade frequency is a lot lower, so it's low to moderate, and you're looking to capture those medium-term price trends of swings. And so here you're focusing on 4-hour and daily charts. And because they're higher time frame charts, you obviously need to be aware and have some skills in fundamental analysis. Position or long-term traders, as it would suggest, the name would suggest, you're in trades for potentially weeks to even months. As a result of that, your trade frequency is low, and you're looking to really gain from those long-term trends. And so to understand when there's a long-term trends, your key trade here is you need to be very proficient in macroeconomics and central bank policies. And of course, then you're looking at daily or monthly charts, as well as fundamental and interest rate analysis. Algorithmic traders, I think it's fairly self-explanatory, where you are relying on algos to do or trading bots to do the trading for you, and that can vary significantly. Certain bots or algos trade of very small timeframes, others are of larger timeframes. So the objective here is you basically it's automated and it requires very little time commitment on your behalf. Carry traders perhaps are less common, but these are very long-term traders or long-term holds in the market. Trade frequency is low. And really here what you're looking at is holding a position to gain profit from those interest rate differentials, obviously taking into consideration the swap fees and rollover fees. But basically here, an example of this, if you look at the pound at the moment, the Bank of England, their central rate is 3.75%. Swiss's lower rate is at 0. So if you have a long pound against a Swissy, in theory, is a positive swap, and that's what you're looking to make your money on. So again, very quickly, just they're the type of main traders or trading styles or categories there are. So to help determine what you may be best suited for, or two, we're going to be looking at your time availability, your personality traits, your risk tolerance, your emotional control, analytical strengths, and certainly lifestyle factors. Today, most of us have very busy lifestyles with work commitments and family commitments. So that becomes a very important factor in determining what type of style that you may be best suited to. So if we look at time availability, well, first of all, if you've pretty much got all day to trade, then scalping and day trading may be a good option for you. If you've got, 1 to 3 hours per day, then day trading or swing trading. Now, I say day trading in this because, as I said, I classify myself as a day trader, and I'm just spending a maximum of 90 minutes per day trading. If you've only got a few hours per week, then those longer term trades like position trading or carry trading may be more suitable for you. And if you've got limited time and you want automation, then clearly using algo trading is the way to go. Now, with respect to personality traits, if you're impatient and need quick results, and again, we're all very different, then maybe you're more suited to scalping. If you like quick decisions, but you still can stay focused, then day trading may be a good approach for you. If you're patient and prefer less screen time, generally as a category swing trading, but I've put in brackets here day trading because, again, for me, I'm a day trader and I only allocate that 90 minutes. So you can have a hybrid approach to that. If you're very patient and a long-term thinker, then position and carry trading. And of course, if you enjoy coding, then algorithmic trading may suit your type of personality. Risk tolerance. Now, we all have, again, very different risk tolerance. If you've got a high risk tolerance, then scalping and day trading may be ideal for you because of high frequency and high pressure. Now, obviously, if you've got moderate risk tolerance, generally it's a swing trader. But once more, I've put day trading in brackets because that's what I do with the Day Trader Pro. And I have a maximum where I place a maximum of 2 trades per day, risking 1% per trade. And so my risk is quite moderate in terms of my tolerance. I don't want to overexpose myself. So you can actually still be a day trader and moderate your risk. And of course, if you've got very low risk tolerance, then those longer types of trades are going to be more suited to you because it requires bigger moves. And certainly that results in less emotional pressure. Emotional control. So if you're one of these very stressful people, certainly avoid scalping and day trading because you're trading off 1 minute and 5 minute charts, and you need to make decisions very quick. And if things go against you, those losses can pile up very, very quickly. Now, if you're calm and emotionally stable, then you may be able to handle those high pressure trades much, much better. So it is important to be do a proper self-analysis of yourself in order to make sure you align yourself with the right approach. With respect to analytical strengths, if you're good at technical analysis, scalping, day trading, swing trading, all right up your alley. And if you're really not so strong on technical analysis, but strong on the fundamental side of things, then those longer term trades and approaches may be more suitable for your personality. And of course, if you're an IT background and you've got good programming skills, then algorithmic trading you may enjoy. All right, lifestyle factors. This is an important uh, component because, as I said, we all live very busy lifestyles. So you have to make a decision. Can you trade during active market hours? Can you trade during the Asian session, or is it the London session, or is it during the New York session? Are you willing to wake up early or stay up late to catch market moves? We know that a lot of action happens during the US sessions, as we saw last night. So are you in a position to be able to get up prior to these announcements and make appropriate adjustments to your trade? If not, then that certainly also helps you make a decision as to when and what and how you should be able to trade. And of course, what other commitments do you have, whether it's your profession, your career, or family commitments, or whatever they may be? How's that going to affect as to when you're going to trade? Because what is important is to be able to trade consistently at the same time every single day, and not trade one day during the Asian session, the next day during the London session, or the following day during the US session. So it is important that we find consistency as to when you're able to trade. All right, so that's the first part of the DNA of a successful trader, is aligning and finding the right trading style for you that's going to give you the best possible chance of succeeding in trading. Now, the next part is essential components of any system. So this applies to irrespective of what type of trader you are, what type of trading strategy that you're currently trading with. You need to ensure that your system and strategy encompasses all of these, or includes all of these components that we're about to go through. So from my experience, having a minimal watch list is very, very important. So by focusing on one or two trading instruments, you're then able to specialize and master the characteristics of those particular trading instruments. If you're focusing and trying to trade 10 or 15 different trading instruments, you're going to struggle, because each of those instruments will react differently to certain market conditions. So having a minimal watch list is absolutely critical. So the last thing you want to do become is a jack of all trades and a master of none. So you want to become a master and specialize. Likewise with time frame, I think it's very, very important that you focus not only on that one or two trading instruments, but focus those instruments on a specific time frame that you feel comfortable with. Because once more, by focusing on that one time frame, you're going to specialize and understand how those specific trading instruments move within that time frame, because you're going to get different messages or indications on a 4-hour time frame versus a 5-minute time frame. So you may actually get conflicting signals. So it is important just to focus on one time frame and specialize in that. So position sizing defines how much you're going to risk per trade. So at the end of the day, irrespective of how strong you feel about how good your particular signal is, if you over position yourself, it's a great way to destroy your account very, very quickly. And so with myself, with the Day Trader Pro strategy that I use, I'm risking 1% per trade on every single trade, irrespective of how confident or how good I think that particular signal is. If it meets my trade criteria, then I'm entering at 1% per trade. So that is important, to be consistent and not overcommit your capital. Having an entry system, obviously the entry is what puts you into the market. And so here the key is consistency. You need to have rules in place that once they are met, you enter the market without hesitation, because quite often, particularly if you're a scalper or a day trader where you're looking for very small moves on smaller time frames, if you hesitate, the trade can quite easily get away from you. And then by the time you enter, most of the move has been completed. So have clear and consistent rules for your entry that you can, as I said, without hesitation, once they're triggered, you're in. Now, once you're in is one thing, but you also need to have clear and defined rules on how you are going to exit that trade once you're in. And by exiting has two components. Obviously, you have a stop loss. If it goes against you, you need to be clear when you place a trade where your stop loss is, but also have rules in place in where and how you're going to take those profits. And like with your entry, rules must be clear and they must be consistently applied, because consistency application is what is going to lead you to consistent results. Obviously, you need to have very clear trading rules. Now, we all as humans, and particularly in the trading industry, we can get very, very emotional and we make decisions potentially on an emotional basis. And so the rules is what holds everything together, and it prevents us from making those emotional decisions, because then we then have that structured framework. Market cycles. So we all know that the markets go through various cycles, whether they're trending or ranging or consolidating, or there's a breakout. And likewise with our respective trading strategies that you may utilize, some will perform better in the trending market, some will perform better in the ranging market. And so it is important to understand where your particular trading strategy is with respect to where it's going to be most beneficial in what type of market cycle, and then aligning that and understanding that, okay, if your particular trading strategy is struggling at the moment, perhaps the current market cycle that you're in is not the most favorable, and therefore that's understandable. So when the market is in your favor, the market cycle, then this is when you need to feel comfortable that take advantage of your particular trading strategy. Correlations, and this goes back to another reason why I strongly, in my opinion, try to minimize your watch list, because at the end of the day, all trading instruments are correlated to some extent. Obviously, some are more correlated than others, and we tend to overlook, a lot of traders tend to overlook this. So for example, if you are buying gold, going long on gold, and also going long on the pound versus USD, thinking that you have two very different trades, one is precious metals, one is Forex. Well, the reality is what you're actually doing is you're doubling your exposure to the US dollar. So you're both expecting, in both trades, a weaker US dollar. So you need to make sure that you address that within your trading strategy system. Now, limits. This is really what this does is determining what your maximum risk and exposure levels are that you're willing to accept. So, for example, you may say, okay, my position sizing is 1% risk per trade, which is great, which is fine. But if you're a scalper or a day trader and you're placing 10 or 15 trades potentially a day, and theoretically you can lose up to 10 or 15% of your capital in that one day. So you need to have limits in place that prevents you from overexposing and your capital. And that may be simply say that, okay, if I've had 3 losing trades in a row, I'm done for the day, I'll move on to the next day. So having limits, overall limits in place is important. And of course, trade management. Once you're in a trade, you need to have very clear rules on how you're going to manage that trade. Part of that is if it's adjusting stop loss to break even, at what point do you do that? If it's taking partial profits, then you need to have very clear rules as to when you do that. All right, now, so the key takeaway is that if you can build your trading system strategy around these essential components, what you are creating is a structure, consistency, and resilience. And again, structure and consistency is what is going to bring you those consistent results. Now, on the flip side of that is things that we absolutely need to avoid doing whilst we are trading, irrespective of the type of trading system or strategy that we are using. I call these the deadly sins. So first of all, never add to a losing position. If price goes against you, then it may feel like if you go in again, you're getting in at a better price. But the reality is, quite often, and in most cases, you actually end up doubling your exposure, and great way to destroy your account. Trading without a stop loss. So stop losses are your safety net, and one trade can actually wipe out days or weeks of profits or even your account. And a classic example when we get to the gold and silver charts today of what happened last night, if you were trading without a stop loss, you could have quite easily wiped out your account. Going all in, so risking your entire account or a significant portion of your account on a single trade is not trading, folks. It's gambling. You might as well go to the casino and bet on black or red and take your chances that way. Changing your stops mid-trade. We've all done that throughout our trading history. If the trade goes against you, don't be tempted to move your stops further right, because once you've moved it and adjusted once and it keeps going against you, you'll be tempted to move it again and again and again. And instead of taking a loss of, let's say, your 1% risk per trade, all of a sudden you are down 5 or 6%. So never change your stops mid-trade to increase your exposure. Revenge trade, natural feeling. We all, as humans, hate to take a loss, and there's a strong urge to win it back. So it is important that you have rules in place to prevent you from doing that. And for me, as I said, on my strategy, I allow myself one trade per strategy, win, lose, or draw. I don't enter a second trade. So that eliminates any potential revenge trading. Chasing trades is also another big one, the fear of missing out. If you're late to the party and the move has already happened, then just stay away from it. There will be other opportunities that come. All good and well, we talk about having a trading plan that addresses everything that you need to do. But if you start to break your rules, then what is the point of having that trading plan? So need to be disciplined here and ensure that you stick to your rules and don't break those rules. Over trading, again, quite often with day trading or scalping, where there's a lot of trades placed in succession. Basically, it leads to decision fatigue. You get mentally tired, and that leads to sloppy execution. And it's a great way to deplete your capital. Trades based on a tip, and this is in today's environment where there's a lot of social media and a lot of people coming up with all these ideas. It is dangerous to do that. And my recommendation is, unless you know the reasoning behind the setup, simply taking a trade because somebody said you need to buy this or you need to go short on this without understanding why, and best to avoid, because if things go wrong, you actually don't know how to manage that trade. And skip journaling. As boring as this sounds, you need to journal every single trade, which is what I do, because if you skip journaling, you can't review your trades, you can't identify what's working, what's not working, and that makes it very difficult or impossible to refine your edge. All right, so they're the three components: determining what style best suits you, ensuring that irrespective of your trading system or strategy, you include those essential components, and thirdly, you need to ensure that you avoid committing these deadly sins of trading. All right, so let's move on to the more, I'm going to say it's all interesting, how to take advantage of current US monetary policy. So, as I mentioned earlier, the Fed started to cut rates in September of this year. So what happens when the Fed cuts rates and stocks are at all-time high? Well, this has happened 23 times in the past when the Fed has cut rates and stocks at the time were within 2% of the all-time high. So this is excluding the cut prior to September that we had of last year. And every time that this has happened, US stock indices were actually higher a year later every single time. And on average, the S&P 500, and those 23 times a year later, on average, was up 14.1%. So this is just a little table just to highlight that. So obviously the data goes back, historical data goes back through 1980 to 2024. Again, no rate cuts between December 24 until September 2025. But as you can see, in all those instances, 12 months later, um, it had the S&P 500 had a positive return. So if we look at 2025, we had a rate cut on the 17th of September. It was almost at all-time highs. The closing price the day before that, as you can see, was 6610 approximately. So using the data that we have and based on an average, we expect the same history to hold and, excuse me, price to be high based on a 4%, 14.1% increase, then you're looking at about 7,500. The October rate cut also almost at all-time highs. That was the price the day before, so a 14% increase. You're looking at about 7,871. So end of day price as of markets close now at 69.34. So what we're saying is that history holds true. We do expect at the end of September 2026 and October 2025 markets, the S&P 500, to be higher than what it was 12 months later. Now, interestingly enough, statistically, within that 12-month period on that historical data, I would say in half those cases, 3 months into it, markets were actually lower. 6 months into it, different again, maybe a third of the markets were lower. But by the end of the 12-month period, in all those 23 cases, as you saw, markets were higher. So I'll be showing you a strategy how we take that data and apply it to 2026 on the anticipation that in September and October, if current market conditions hold, then we expect the S&P 500, even NASDAQ, the other stock indices to be higher. All right, gold and silver. Will the bull run continue in 2026? And I woke up at 4:30 or quarter to 5 this morning to find that we had a major reversal in the markets. So this is the chart for the last 6 months, finishing up on the 29th. So day before yesterday, you'll see gold prices basically increased over almost 65% in the 6-month period, and silver has been at a tearaway at over 200% increase. Now, obviously, we had a major correction, and we'll address that shortly overnight. And so this is how the markets finished at the close of the Friday trading session. Still, even with that major correction that we saw overnight, gold is still almost 50% up in the last 6 months, and silver is still over 130%. So the bull run is certainly continuing. Now, I do expect it to continue. So some of the reasons, let's understand the reasons why and what's driving these bull runs for silver and gold. So certainly silver, there's a structural supply-demand imbalance. So basically, at the moment, global demand exceeds mine production. And stockpiles are shrinking, so that's going to cause supply and demand, basically, price to increase. Certainly rising industrial demand. So over half of demand for silver comes from the industry, whether it's renewable energy, electric vehicles, semiconductors, emerging technologies. All this is causing and contributing to silver prices increasing. Various macro and monetary economic forces, like interest rate cuts, geopolitical tensions, safe haven flows, all contributing to the price of silver. And one of the big changes also is that there's been a high inflow into silver exchange traded products and physical holdings. So that's all contributing to the price of silver moving forward. Gold, same geopolitical and macroeconomic risks, central bank purchases and structural demand. So central banks, especially in Asia and emerging markets, have been accumulating gold. And expectation of monetary easing. So obviously, with the US cutting interest rates from September, that has helped drive markets higher for gold. All right, so this is actually had to amend this slide today, given the reversal. So at the start of the year, and these are my targets that I had for quarter 1, not expecting the massive moves that we had in September. So my conservative target was 5,000 for gold and 100 for silver. And as you can see, those targets were met in January. And these are more bullish type of targets. Now, we saw in the last 24 hours gold drop by 13% or correction by 13% and silver a correction by 30%. So massive corrections. Obviously, both have been on a bull run. There needed to be at some point in time, there needed to be a correction. Didn't expect such a large correction, but we were always going to have a correction at some time. And so we needed a trigger. And a trigger happened last night where a couple of things, or a number of things actually caused it. News came out that Trump intends to nominate Kevin Walsh as the next Fed chair. He's perceived more as hawkish, and so the markets, rather than dovish, so the markets did react to that. There's also, if you recall, government funding runs out at the end of January, which is now. However, there is a new bill that's being voted in the Senate today, Saturday, US time. So that was a positive trigger on that as well. And obviously, a lot of profit taking being done at the same time. So all of this has contributed to this massive correction. So, however, when you look at the bigger picture, the core macroeconomic conditions are actually still in place. And so for me, with this major correction, I might just go back a slide. It just prevents us, I believe, further opportunities to go back into gold and silver. And okay, so we'll have to go back and looking at these original targets for gold and silver. Now, don't expect it to move as quickly as it did in January, but certainly, as I said, at the moment in Q1, those macroeconomic conditions are still in play. And so we should still see some continued bullish movement. All right, so how do we take advantage of all of this in less than 5 minutes a day? So let's go to the actual charts. All right, so this is silver, and this is a strategy that I shared with my Day Trader Pro group at the beginning of November, and expecting the bullish run for silver and gold to continue. And as I said, it's the same strategy that you can apply, and I've been using on US stock indices and both on gold and silver. So first of all, it's a daily chart, and we only use one indicator. This is the 8 EMA, 8 exponential moving average. And so as long as there's fundamental reasons or macroeconomic reasons why you think this particular trading instrument is going to be bullish, this is what we are simply doing. So first and foremost, what I'm looking for is, and we'll go through silver as right from November right through to current, is I'm simply looking for a bullish candle close above that 8 EMA. So that was their first candle right there. And all I'm simply doing at the close of that candle, the following day, I'm looking to enter. So theoretically, entry somewhere there. And my stop loss is under that low of that candle. So then we're basically holding that as a basic strategy. You're holding that until okay, I can't see the chart. I apologize. All right, so we'll go back to the chart, daily chart. This is the white line is the 8 EMA. That's the only indicator that you actually need. All right, just making sure the screen is back. And so I'm looking for a bullish candle close, and I'm entering the following day. Your stop loss is there. And so basically I'm holding that position until I get a candle close back under the 8 EMA. So in this particular case, I would have been triggered out of that trade at the close of that. So that's my entry. So I would have taken a small actually, let's go back the other way, would have taken a small loss that day. And then I'm simply from there, I wait until I get another bullish candle close. And my next bullish candle close above the 8 EMA is there. Let's just move that across. So my entry would be the following day, stop loss somewhere here. And then I am holding that trade until we get a close back under the 200 EMA. Sorry, back under the 8 EMA. So you can see here, for example, the risk to reward, that's your initial risk. Capturing this massive, massive move. So we're out there. So from there, we continue looking. Let me just get rid of all those lines. We're out of the trade there, looking for another bullish candle above the 8 EMA. This is the next bullish candle. We're placing our entry at the start of the following day, stop loss back under here. Now this, although throughout the session it did move back under the 8 EMA, at the end of the day, if you're patient enough, it hasn't closed. We're back at it. So you're basically riding all this way up pretty much until, and that's the big reversal that we had today. So again, a fairly big run. Now, that's a basic strategy. Now, obviously, as price moves in your direction, you're not going to leave your stop loss where it is, okay? Because you can wipe out quite quickly. We know markets are volatile. So one of the things you need to do as it goes in your favor, you need to be consistently adjusting your stops. So you're locking in profit continuously, obviously allowing enough room for it to move back under here. Now, in terms of how you adjust that stop loss as you move forward, there's a lot of different ways. There's no specific system apart from your initial entry. As I said, we have it below the initial entry candle. From then on, there are a number of different ways. You can use the ATR, which is average true range, and have a multiple of that. Or you can say, once I'll adjust it once to the second candle back from the current day, or the third candle back. So there's a lot of variations in terms of how you manage that trade. And so one of the things that will be interesting is that when Mike Smith comes on board, is going to be talking to you about different stop loss strategies and exits. And so you simply need to find one that you are comfortable with, that's with respect to your risk tolerance. So that's the very simple strategy, and it literally takes me a couple of minutes every day to have a look at the next bullish candle. So for me, if I look at silver at the moment, and again, gold and stock indices are an identical approach. Yes, we've had a major correction. So now I'm looking to re-enter long again, because for me, the core macroeconomic environment still is in play. And I'm now looking for a bullish candle to close back above the 8 EMA. All right, so we've only got 5 or 6 minutes left. So I'm happy to take questions. As I said, I can go through gold, but it's going to be literally, it's the same approach on the US stock indices. It's exactly the same approach on the system. And as long as the core macroeconomic reasons still exist, which I believe for gold and silver, they are still in play. And we saw the stats, historical data on US stock indices, that 100% of the time, last 23 times there's been a rate cut, stocks were higher 12 months later. So I am basing myself on that approach. All right. So what I'm happy to do now, happy to take some questions. So perhaps Avi, you can assist me in sort of scrolling through the questions if anybody has. The
Yes, of
other thing I
course.
will, sorry, I'll
Sorry, please go.
just mention one thing, particularly with silver and gold trades. After the question, I I get asked when is the best time to enter. I would generally wait until the Asian markets open and give it 15, 20 minutes to see whether there's a slight pullback before it moves higher. So certainly I'd be inclined to wait for that and just get confirmation that it is starting to move. Um, yeah. All right. So thank you for your time. I'm happy to take questions.
Uh, okay. Just a few. Let me see. Uh, do you use market orders or limit orders?
Market order. So generally, as I said, I've been entering both the US stock indices and the precious metals within sort of 15, 20 minutes after the markets in Asia have opened. And I just go in at that price. These are long-term moves. So whether you enter 15 minutes later or 20 pips higher or 20 pips lower, it doesn't really matter because they're quite big moves.
Okay. And the stocks do not wait for the daily close, right?
Sorry?
The stock levels, you're not waiting for the daily close.
No, no, I do. So every month, if I'm in a trade, then once I've entered, I'll wait for the next daily candle to close, and then I'll make a decision depending on how far it's moved or hasn't moved, whether I adjust my stop loss or not.
So if there's a big candle that goes through the moving average, what happens?
Well, normally there'll be a stop loss in place already.
Okay. So
Um,
so
so
there is a
let's,
stop loss, right?
sorry,
Without waiting for the daily close, there is a stop loss.
there is a stop loss. I just simply, if I need to adjust it, I do it at the end of each day. By adjusting, I mean moving it higher to lock in some profit. So if I'm seeing a consistent bullish approach, then moving it higher, but obviously not choking it out. And as I said, there are different ways to take the approach. You can leave it 2 day candles behind, or you can use a multiple of the average true range, or there are many ways. It's just as long as you are consistent in your approach.
Yes. So I guess to simplify this question, to answer quite simply to the question is that yes, the stop loss, there's always a stop loss there. So it goes through intraday, the stop is triggered, it's triggered. That takes care of price action, much like the 1 day 30-40% move that we saw in silver.
Right.
But the adjustment of stop losses, wait for the stop loss is in there, but Alex waits for the daily close before he decides to move the stop loss higher to protect his profits, right?
Correct.
Okay. Oh, we have a lot of questions. A How does this strategy do with more sideways price action?
Okay. Maybe again, once I've entered, so the critical entry is we're going bullish. We simply need a bullish candle close above the 8 EMA. Now, as long as the daily candles stay above the 8 EMA, and there are days where its price is sideways, then we stay in the trade. So once it closes below the 8 EMA, then we're out. Otherwise, we stay in.
Okay. Uh, what markets can you use on this?
Okay, so the strategy is twofold. One is on precious metals, gold and silver. You can use it in copper as well. But you need to have valid macroeconomic reasons to do that and to support your bullish run. And I've shared my views on why I think in Q1, whilst those conditions for gold and silver are in play, there's still an opportunity. With respect to the US stock indices, and I do both Nasdaq and the S&P 500, I'm using the analysis of the historic data of the last 23 times Fed cut rates. This is what's happened. Obviously, I don't know whether it's going to be a 14% increase or a 5 or a 20, but I'm of the opinion that I'm following historical performance, and I do expect in September and October the S&P 500 and Nasdaq to be higher than where they were in 2025, and so I'll continue using the exact same strategy. Um, Daily close above the 8 EMA. I'm going in, and I'm holding that until it either closes back below.
Okay, so we have no time to answer all these questions. It's all the questions are all very curious. But for those of you we didn't get to answer your questions, you can register your interest. And for those who are very interested in how you can learn more about Alex's trading strategies, there's a QR code here, a link there. It's Sue will put it in the chat as well. Just go there, register your interest for his courses. He is still thinking of when to resume streaming his trading. There's quite a number of queries asking for him to stream his live trading every day to just see the various different strategies and he can talk about markets. But that's all still something that he's considering. If you are very interested, please register your interest, and then when the intake becomes available, when he decides to do it, then you'll be the first to be notified and be given the chance to watch Alex live in trading and see how he struggles and overcomes the merciless markets that we have today and expected to be for the rest of the year as well. Thank you very much for being with us. The next session begins soon, so I guess we are going to have a break here, right? Maybe we can have one last question, which is what's the strategy for S&P in anticipation of 14% growth in September 2020 by September 2026?
Okay, as I mentioned, the strategy is exactly the same as what I suggested, I'm not suggested, showed you with the silver charts. Now, I said I've used an average of 14.1%. I'm working on a basis that it will be higher, whether it's higher by 7% or whether it's higher by 20%. Obviously, it's unclear. But every time there's a pullback, I see there's an opportunity to go back long. Because, as I said, historically, 12 months later, it's always finished higher. In the interim, as I mentioned during the presentation, half of those 23 times during the first 3 months, they were actually lower. 6 months later, about a third were lower, but ultimately at the end of the 12-month period, in all cases, it was higher. So, as I said, the strategy is quite simple. A daily close above the 8 EMA, I'm entering, stop loss under that daily candle. And as it moves in my favor, adjusting the stop losses until such time that it closes back under the 8 EMA. And for more sort of stop loss exit strategies, Mike Smith will be covering that in a lot more detail. So you actually may find something that you are comfortable with in how to manage the stop losses of these particular setups.
Yep. So you can actually adapt this to various things that you watch, right? Have an underlying theme or idea for the trend, and then use this method that he has, which is quite structured and simple, in fact, right? As long as you're disciplined enough to follow through with it. And if you're right about the underlying theme, a lot of people know that there's a bull market going on in some of the things that we are watching, but they don't know really how to trade it, right? They chase it to the tops, stop out at the bottoms, right? And then see the whole thing rise maybe double within a year, but made no money or maybe lost money in the process, right? So this is a good method to ride a long-term trend. Of course, we will see many different days of the merciless markets trying to push you out of the trend. But if you have a stop in place, you don't get in along the way of the whole correction. You just wait for it to again appear above the moving average that Alex uses. Alex, we have one question here also. Maybe you would like to answer. Do you use prop firms?
Yes, I do. I think it's a great way uh, not to have to worry about your own capital. So, yes, obviously each prop firm differs, very strict conditions that they have. So, if you choose to go with a prop firm, make sure you read the terms and conditions that they apply. They're all very, very different. So, it is important to do your appropriate research.
Okay, cool. With that, we have come to the end of Alex's session. Thank you for the
Thank
many
you, everyone.
questions.
Thank you, V.
And if you have more questions regarding his strategies or are interested in joining his next intake for his Day Trader Pro program, which he adapts and constantly add different ideas along the way as well. Uh, just register your interest using the QR code on your screen or using the link in the chat. And if you want to watch more of him, please tell him, and then maybe he will decide to do so by popular demand. As always, thank you, Alex. Thank
Thank
you
you,
for joining
everyone.
us. Thank you for your
Thank you.
insightful sharing. We are going to take a break, and then we're going to resume in 5 minutes' time, 9:30 Singapore time, 12:30 Melbourne time, for the next speaker who will be joining us. Thank you.